If you are interested in investing in dividend stocks, then all you need to do is to blindly follow Warren Buffett. Warren Buffett is a legend in the American stock market, and he's got a knack for picking out the best dividend-paying stocks. It's not just about going after stocks with the highest yields, it's way smarter than that. Warren Buffett's approach to dividend investing is like a perfect mix of simplicity and smarts, sprinkled with a good dose of common sense. He looks for top-notch businesses that don't just pay dividends now, but are likely to keep paying, and even increasing those dividends in the future. It's all about long-term, stable growth. So what are the secrets behind Warren Buffett's strategy? What makes him pick one dividend stock over another? Well, I am about to break it down for you. I'm Will, and I teach people about investing, personal finance, and money. I've walked the path you seek, and today I have several businesses and investments that provide me income every single month, meaning I never have to work another day in my life. If you plan on becoming financially free, be sure to subscribe to the channel and hit the like button if you find this video valuable. In this video, I'm going to discuss the most crucial factors that Warren considers when hunting for those golden dividend stocks. These are strategies that could help you steadily build your wealth, just like Buffett has done over the years. All right, the first secret of Warren Buffett's dividend investing strategy is he goes for businesses that have been around for ages. We're talking about companies with a track record that stretches back decades, even centuries. Think Wells Fargo, American Express, Coca-Cola. These giants have been around since the 1800s. And then there's IBM, a youngster compared to the others, founded in 1911. Even Walmart, the most recent in Buffett's top picks, has been around since 1962. Now you might be wondering, why does Buffett care so much about how old a company is? Here's the deal. Companies with long histories tend to be more predictable and stable. They've been through it all. Economic ups and downs, changing trends, you name it, and they're still standing. That's a good sign they're doing something right. These businesses have figured out their game. They know what works and what doesn't, and they stick to it. Sure, they adapt to changes, but at their core, they stay consistent. For example, the banking industry, where Wells Fargo and American Express play, hasn't changed its basic model in ages. Then there's Coca-Cola, a century-old soda company that's now dabbling in juices, water, and tea. The beauty of investing in these old-school companies is their likelihood of continuing to generate cash flow. The slower an industry changes, and the longer a business has been thriving, the more probable it is that the business has a solid competitive edge that'll last well into the future. So, in essence, Warren Buffett's approach is pretty conservative. He looks for companies that have proven their wealth over a long period, not just ones that have had a couple of good years. Moving on, the next key secret in Buffett's strategy is he finds businesses with strong, lasting competitive advantages. Think about it like you're a business owner. You'd want your business to not just beat the competition, but to have something special that keeps them at bay, right? That's exactly what a durable competitive advantage is all about. Buffett himself says, "I am a better investor because I am a businessman, and a better businessman because I am an investor." This mindset helps him spot companies that aren't just doing well now, but have something unique that'll keep them on top for years, maybe decades. Competitive advantages can come and go. Remember BlackBerry? It looked unbeatable once, with its stock soaring above $200. Now, it's a different story. The market is full of examples where companies shot up fast, but then lost their edge. So, finding those rare gems, companies that can maintain their competitive advantage year after year, that's the challenge. These are businesses that enjoy higher than average returns, which they can reinvest for growth or give back to shareholders as dividends. Walmart's a classic example in Buffett's portfolio. It's huge, and that size lets it push suppliers for the best prices, which it then passes on to customers. This creates a positive feedback loop. Lower prices bring in more customers, growing sales, making Walmart even bigger, and the cycle continues. So, when you're out there looking for stocks to invest in, remember this Buffett secret. Don't just look at what a company is doing now. Dig deeper and find out if it has a competitive advantage that's likely to last. Now, the third secret is Buffett's knack for finding undervalued businesses. His mentor, Benjamin Graham, known as the father of value investing, really influenced Buffett's approach. Graham was all about finding companies that were trading for less than what they actually were worth. This philosophy of buying stocks below their intrinsic value became a cornerstone of Buffett's strategy. To find these hidden gems in the stock market, you often have to look at the most beaten-down, unloved stocks. The flashy, high-flying growth stocks? They're usually not where you'll find real value. Value investors like Buffett often go against the crowd. Be fearful when others are greedy, and greedy when others are fearful. That's one of Buffett's famous sayings, and he loves it when a great company runs into temporary trouble. He says the best thing that happens to us is when a great company gets into temporary trouble. We want to buy them when they're on the operating table. This philosophy led to his major investment in American Express during its salad oil scandal. If you're still watching, I'd really appreciate you hitting that like button, and it helps the YouTube algorithm promote this video. All right, let's talk about the fourth secret. He keeps a focused portfolio. Buffett's strategy here really sets him apart from many institutional investors. He doesn't scatter his investments across hundreds of stocks. Instead, he keeps it tight. His 5 largest holdings make up a whopping 67.5% of his total portfolio. This approach is starkly different from the usual practice of diversifying a portfolio to the max. You can't beat the market by just being in the market. Buffett puts it bluntly. Diversification is protection against ignorance. It makes little sense if you know what you're doing. The idea is if you really believe in a stock, if you're confident it's undervalued, has a strong competitive advantage, and is likely to grow in the long run, then why not go all in? Benjamin Graham, Buffett's mentor, suggested holding around 20 equally weighted stocks. This way, you invest in your top ideas, the ones you believe will perform exceptionally well, while still reaping the benefits of diversification. Having hundreds of stocks in your portfolio might feel safe, but it's likely to lead to pretty average results. The sweet spot? A portfolio with 12 to 20 positions, giving you enough diversity to spread risk, but focused enough to make meaningful gains on your best picks. Remember, Buffett has been holding on to stocks like Coca-Cola for over 25 years. His focus isn't on quantity, but on quality and conviction. Okay, so the fifth and final secret is Buffett is investing for the long haul. We already talked about the importance of picking companies with a solid track record, but for dividend investors, there's another piece to this puzzle, choosing investments you're comfortable holding on to for years, maybe even decades. Buffett famously said, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. That's the essence of long-term investing. It's not about quick flips or chasing hot tips. It's about finding those rare, exceptional companies that you can stick with over the long term. Plus, long-term investing comes with tax perks. The less you sell, the fewer capital gains taxes you pay, letting your investment continue to compound. Another upside of holding stocks for the long term is reduced turnover in your portfolio. This means you're saving on transaction costs, slippage, and other fees. Lower investment costs mean more money working for you in the market. So the takeaway here? When you put your money into a stock, think about whether it's something you'd be happy holding on to for a long, long time. It's about letting your money grow steadily, enjoying tax efficiencies, and keeping costs low. A triple win for any investor. If you're building a dividend stock portfolio, watch this video next to find out the 5 best dividend stocks you can buy.